The primary reason to reinvest your dividends is that doing so allows you to shop for more shares and build wealth over time. If you examine your returns 10 or 20 years later, reinvesting is more likely to extend the worth of your investment than simply taking the cash. Also, reinvesting allows you to buy fractional shares and obtain discounted prices. There are times when it makes better sense to require the cash rather than reinvesting dividends. These include after you are at or near retirement and you would like the money, when the stock or fund isn't performing well, once you want to diversify your portfolio, and when reinvesting unbalances your portfolio. Within the last case, if you're overweighted in barely some of investments and therefore the securities don't perform well, then you stand to lose quite if your portfolio is more balanced. Dividends are payments passed back to investors, usually when an organization posts a profit. Stocks and funds can both pay dividends, and also the amount and frequency of dividends paid can vary by company or fund. Dividends are considered income, so it's up to you to settle on what to try to do thereupon income. Many of us prefer to use the cash to reinvest within the same companies or funds, while others like better to take the cash. While taking the cash can add up for those within the later stages of their investing journey, experts say that reinvesting your dividends and tapping into the magic of compound growth is the better move for many investors. Here's what to grasp about dividend reinvestment and the way to use it to grow your wealth. When companies make more earnings than their expenses, they will reinvest the additional money in their own company, or pass it to the shareholders as a dividend to share the profits, explains Gina Sanchez, Chief Strategist at Lido Advisors, an LA-based investment consultancy. You'll be able to think about dividends as the simplest way companies reward long-term shareholders for owning their stock. Not every company offers a dividend. Some companies favor to reinvest their profits into research and development to grow their business and lift the stock price, whereas others share their profits as dividends with investors. Companies with a proven journal of accelerating dividend payouts to investors per annum are referred to as dividend kings and dividend aristocrats. When a dividend-paying stock or fund declares a dividend, it's paid bench shareholders, usually as cash but occasionally as additional shares of stock. Dividend reinvestment plans, also cited as DRIPs, are a meeting that allows shareholders of certain securities to use their dividends to get additional whole or fractional shares of a stock, ETF, or investment firm for no added cost. If you've chosen to reinvest your dividends, the cash are accustomed to purchase additional shares of the underlying investment, which increases your holdings within the company or fund. Reinvesting dividends puts your money to figure for you, explains Sachin Jungiani, co-founder and CMO of Elevate.Money, a true estate investing platform. You can also opt to take the cash to spend whatever you would like, wish to cover your living expenses, or, if you wish to limit your exposure to a selected company or fund, you'll take the dividend as cash and use the cash to shop for other investments to diversify your portfolio further. While it would be tempting to require the cash, reinvesting might benefit you more within the long term, especially if you're receiving regular dividend payments from profitable investments. If you've got a protracted investment timeline or don't need additional income, experts recommend reinvesting your dividends by acquiring more shares of stock. That way, the money you earned is employed to earn even more cash for you within the future. But if you're retired or need supplemental income, dividends are often a valuable supplemental income source. In fact, many retirees use their dividends for everyday living expenses. If you're within the accumulation phase where you're saving for retirement while working, you don't need the income from dividends, so you'll likely want to reinvest it, says Sanchez. Once you reach retirement, you'll enter your distribution phase and begin taking money out of your portfolio to keep up your lifestyle. At that time, you'll lean toward taking the income from dividends instead of reinvesting it, if it's an element of your income needs. Ultimately, the simplest account you'll rely upon while you're on your investment journey. When you enroll during a DRIP plan, you get an automatic, set it and forget it experience. When a corporation or fund posts a dividend, your brokerage will purchase more of the asset on your behalf and add it to your account. These purchases are usually commission-free, and everyone the cash are want to buy more of the identical underlying fund. If the dividend amount isn't enough to get a full share of the stock or fund, most brokerages will allow you to get fractional shares. All of this typically happens within some days of receiving a dividend. Keep in mind that the majority employer-sponsored retirement accounts and a few IRAs will automatically reinvest your dividends by default. If you're unsure about your enrollment status, take care to test your account settings or reach Resolute, a financial professional which will facilitate you along with your account. Pro tip: when you're saving for retirement, you'll presumably want to reinvest your dividends to stay your money working for you. There are a few instances where taking the cash is favorable when you're in your accumulation phase. If you don't want an automatic dividend reinvestment plan, you'll be able to favor to receive cash, then use the cash to get more of the identical stocks or funds. Some investors will save their cash and buy more securities when the market dips, though trying to time the market isn't necessary for long-term open-end investment company investors. Others might take profits from income stocks to shop for growth stocks. Otherwise, you could get the cash and buy another stock or fund for more diversification in your overall portfolio. Anytime there's income, the government wants its share of taxes. Dividends are not any exception. While reinvesting dividends doesn't have any special tax advantages, doing so will still have the benefit of being taxed at the lower long-term capital gains rate. Dividends received as stock are usually taxed when the stock is sold. Qualified dividends, which are those held for a particular length of your time in domestic corporations, are taxed at the long-term capital gains rates of 0%, 15%, or 20%, looking on your income tax bracket. Non-qualified, or ordinary, dividends are those who don't meet the IRS criteria for special tax treatment, and include dividends from property investment trusts, REITs, master limited partnerships, MLPs, foreign corporations, and special one-time dividend payments. These dividends are taxed as ordinary income. With most retirement accounts and traditional IRAs, you'll pay taxes after you withdraw, after you're 59 and a half, at whatever your current tax rate is at the time.